Seller finance notes, gosh, it took me years to realize when I buy property subject to and sell it to a homeowner, I'm really in the note business. That's what I'm doing. I don't really own real estate. I create notes, and that's what I do. So, and I like to keep my notes for cash flow, but there are a lot of people who it seems actually structure these things to sell them off and be out of the deal, which I found a little bit shocking, but it seems like there's a big market of people that do that. So, seller finance notes, how to create those that are highly marketable and that people will give you a good price for. That's what we're talking about today on the Sub2Deals Show. Welcome to the Sub2Deals Show, where we talk about all things subject to. My name is William Tingle. I've been a real estate investor for about 23 years now. Gosh, I'm getting older and older. Today, we have one of our real investor expert episodes where we bring in experts in some field of real estate investing. This episode today is sponsored by Big Insurance, Birmingham Insurance Group. Whether you're an investor, a landlord, a rehabber, a creative finance guy, doesn't matter. Big Insurance can handle all of your insurance needs. Probably the lowest cost you'll find anywhere. So check those guys out at bhaminsgroup.com. And if you're looking for the most affordable creative real estate financing coaching on the planet, check out our group at $7coaching.com. I guarantee you won't find a better deal in coaching anywhere. Our expert today is Chris Seveney. Chris is a note expert. We're talking about notes today. Chris has been in the note investing and real estate field for 25 years and has managed over $1 billion in real estate. So I don't think we could find a better expert to bring on and talk about real estate and notes. So Chris, I'd like to welcome you to the Sub2Deals Show.
William, thanks for having me on again. How are you doing today?
Man, I am finer than frog hair. Hope you're doing the same.
Never heard that one before.
Well, listen, hang out with me, buddy. I'll tell you all kind of things you've never heard before. But yeah, that's one of my favorites. Finer than frog. That's pretty fine. Have you ever seen much hair on a frog?
So I have not.
Well, there you go. It's pretty fine. Okay, so Chris, tell everybody a little bit about yourself and how you got into notes and what you do.
Great. So I've been in real estate pretty much probably started around the same time you did, about 25 years ago. My path into real estate has been more through the W-2 workforce, where I graduated college, and then after that started working for a large commercial general contractor. Got to manage some really cool large construction projects for about 15 years. And then once that burnt me out, I started working for a real estate developer, was building a lot of high-end condos for the last 10, 15 years. And as I started to get wiser and start building my own personal portfolio, kind of played with a lot of different avenues of real estate, got some buy and hold rentals, looked at tax liens, and then eventually found my way into notes about in 2016. And since that time, started off slow, buying a handful at a time, to now we manage about 250 at any given point. We've bought and sold over 500 notes during that time, and have since that time also gone out, raised money through funds. So we've got to see many different aspects of real estate, and also how to structure deals, how to raise money. So and part of me, I just love to talk, and talk about real estate in general is just something I'm very passionate about.
Right. Right. I know what you mean. I love real estate. I knew as soon as I bought that Carlton Sheets course, I mean, I had really found what I was supposed to be doing. It's interesting,
Mhm.
like that. But I've always only been interested in single family stuff. Now, you talk about notes and those things. I mean, are you into all of it? I mean, whether it's commercial or single family, or do you mainly focus on one type?
Mostly single family.
Hmm.
We, started out buying notes typically between 20 and 250,000. So the
Hmm.
commercial side of things usually is another notch up, and
Hmm.
I feel we've gotten very good at the single family, owner occupied type of notes and how we manage and structure those deals. So we're a type of company that we manage. Hey, if we're good at one thing,
Right.
let's focus on our bread and butter. Will we try other things, or if there's one-offs that come up, absolutely we'll look at things. There's other types of loans called like the HECM loans, which are the reverse mortgages.
Hmm.
We've done some of those in our portfolio, but I'd say 99% of our portfolios residential, single family, and the
Hmm.
commercial deals we've looked at typically have been small multifamily, 6 unit, 8 unit apartment building.
Right.
But again, typically it's all been housing.
Hmm. Okay. Well, I have always, in seller financing, I have always fully intended to keep the notes that I create. That's just
Mhm.
always been my thing. I've always wanted cash flow. That's the thing I want to do. I know some people, I've heard them talk about running into situations where maybe you needed some cash or something like that. So you would sell a note. Admittedly, I am not very experienced in notes and how they really work. Um, but that got me interested. I know I'd had you on before, and I said, well, let's bring you back and talk about how, if you're, let's just say that somebody that operates like me, I go out, I buy houses, I take over payments, and then I just create a secondary note
Mhm.
for my buyer. That's what I do. Now, if I wanted to liquidate a note like that, let's just say that I need some cash and a chunk of cash, and I want to sell that note. What is the best way for me to structure that thing to get the absolute most on the market
Mhm.
for it?
Yep. Well, one of the things that most investors look at and talk about a lot with notes is, the velocity of cash flow or getting your money back.
Right.
And I think today more people will realize on the seller financing side because what's going on in today's economy versus about 6 to 8 months ago.
Right.
And I say that because 6 to 8 months ago, people always thought interest rates would be pretty stable. People
Mhm.
were doing seller financing at like 5% when the markets are at 3.5%. And now, if you're writing something at 5% as seller financing, you're below market. I checked my bank today, 5.5% for me to go get a 30-year
Right.
mortgage. So some when back to that velocity, things that people look for are how much money, what's that monthly payment, and the ways to increase that monthly payment are several factors. One is uh, shorter loan terms,
Mhm.
and then also higher interest rates. One philosophy you'll hear people say is called the 10-10-10 rule,
Mhm.
which is you want at least 10% down because you want some skin in the game. And
Right.
then an interest rate, again, if the usury laws allow it in the state, of around 10%. We typically write ours at like 9.9. So
Mhm.
we're still in quote unquote single digits.
Right.
And then we'll usually write them at 10 years. Or if we do amortize them longer, we'll try and put a balloon on them again if it's allowed to get that money back. And I'll go back to that example I mentioned is if you originated a 30-year note 6 months ago at 4.5 or 5%, that borrower is never going to refinance,
Mhm.
and you're kind of you can't do anything with that note, or if you sell it, you're going to have to give such a heavy discount because people can originate their own notes now for
Mhm.
higher interest. So
Mhm.
that's something to definitely be aware of, and that's kind of one of the mistakes that I see is people really want to get rid of their property, so they offer such great terms.
Mhm.
But one of the terms you want to do is kind of dangle it out there because if you get a borrower to refinance down the line, again, that's just adding more money in your pocket.
Right. I can't imagine financing someone at 4.5%. Now, our rates will typically fall between 6 and 9, and
Mhm,
that's been historically over the last several years. Now, of course, they
mhm,
may go up, but we
mhm,
try to balance things with what market rent is. I mean, that way
mhm,
it encourages people who are renting. If their
mhm.
house payment's only $100 or $150 more, well, it's kind of a no-brainer. Then you should buy
Yep.
that house.
Mhm.
But we do get 10% down. But now something I've done, it sounds like I've made my note, I've really devalued the ones I have, is that we do an amortization for 40 years with no balloon.
Okay.
That would
So
not be that would not be attractive to Chris, I'm not thinking.
no, it wouldn't, but it's also, again, look at it from everything's got to be based on the investor and what's their exit strategy. You
Right.
mentioned off the top, you can't imagine selling those, so you want to keep these for long cash flows. If you got a 40-year loan, 90%, at least 90% of that payment, I'm guessing, is interest.
Oh man,
So
it's more than that.
yeah, so you're
Yeah,
basically just
sure.
collecting
Right.
interest. It's almost like an interest-only loan that's going to take you till the time, for the next 40 years. That's not a bad thing.
Right.
And that's the one thing I try and explain to people is, you know, it's all depends on what your exit strategy is. If
Mhm.
you want to hold these things, yes, what you're doing is perfectly fine. But if you're saying, hey, I want to try and sell these things after 6 months of seasoning for the highest price, that's a
Mhm.
completely different animal
Right.
from what you've done versus somebody else.
Right. So actually, I met somebody recently who teaches a method where they actually create a first and a second,
Second,
and
yep.
then they market the first
Hmm.
and claim that they get 92% for that first, which
Hmm.
pays it off, and
Hmm.
then they just keep the second for for cash flow purposes. But what that requires is that you get that property at a discount.
Hmm.
So you're having to buy at 70, 75 cents on the dollar. And that's been pretty challenging for the last couple of years. I mean, sure, there are always exceptions, there are always deals out there.
Hmm.
But if you're buying no equity or very low equity like we do, there's no way to
Hmm.
structure that sort of thing.
No, yeah, that's very challenging in today's environment. I think in the next 12 to 15 months or next year or two, I think you may have some opportunities.
Mm-hmm.
The other aspect to this is also, you know, if you are going to look to sell, who are you marketing it to? And people reach out to me, and I'll be, again, I'm a distressed buyer. I'm buying
Mm-hmm.
stuff at a discount, so I'm, gonna want to buy it at a discount. But if you go over, there's a company called FNAC, First National. I forget, it's FNAC. But they buy notes all day long from investors, and they'll pay 90 to 100 cents on the dollar if the borrower's got a credit score above 600, or
Mm-hmm. Right.
so that's somebody I tell people, hey, go market to them, because I'll give you 70 cents on the dollar. They'll give you 95. Why are you going to sell to me? you
Right.
know, uh,
Yeah.
but
Mhm. Oh, well, I'm sure those guys, though. I mean, and there are some other things I know that are attractive to you guys as
mhm,
note buyers.
mhm,
You guys take into consideration whether a servicing company has been used and
mhm,
where the buyer was run through a mortgage broker and that sort of
mhm,
thing. Y'all are looking for a specific package, I think,
mhm,
when y'all are
mhm.
looking at buying notes. Is that right?
Yeah, so that's something important to look at. There was somebody in the southeast who was they were really a fix and flipper, and what they were doing was they're putting more lipstick on the pig and seller
Mhm.
financing these properties to buyers, but they weren't even running credit. They weren't
Mhm.
running any checks on them to see what their income was. They were just putting them on the loan, then turn around and selling this thing. And that's no different than you walking down the street and say, here, I'll sign you up for a note. Just sign here, and hopefully you can make the payments.
Mhm.
As somebody who buys notes, having a an analysis, just like if you were buying a house, somebody's checking your credit, somebody's running to make sure you can afford this thing, the ability to repay. That's something we look for as well. Credit score is not as important to us as the ability to repay,
Right.
because somebody could have gone through a divorce, somebody could have had lost a job and had huge medical bills that crush their credit, but now all of a sudden they're making $10,000 a month and they want to have $1,000 month
Right.
mortgage payment. and they live a somewhat frugal life. Okay, I'll take that person every day over the person who's got a 700 credit score, but is always buying the new iPhone, spends $1,000 a month on Amazon, and lives paycheck to paycheck. And
Right.
the reason that their credit card's so high is because they're barely getting by. But if they have one thing happen in their life that throws a wrench in it, all the blocks come tumbling down.
Yeah, for sure. When I started, of course, after I'd been an investor for a while and I'd done pretty well, I started actually doing some hard money lending. And the guy that I learned from, one of the first things that he taught me that I really took to heart, and I made sure I did on every deal that I would lend money on, he said, it doesn't really matter so much about the person. You lend based on that property. Now, do you guys look? I mean, how much bearing does the property have? I mean, I know if an investor approaches me and says, "Listen, I can buy this house right here. I need X amount of money. I need money for fix up. I'm gonna do this, do that." I'm purely looking at the value of that property, and would I be sad if I had to take it back? Worst case scenario. So, do you guys do that at all?
Oh, absolutely. At the end of the day, the property is what secures our money. So you definitely want to make sure you understand the condition of the property as much as possible. And is that a property that you'd want to take back?
Mhm.
You got to be careful because it's not only the property, but the location of the property. If it's an area where bullets are flying every day,
Mhm.
it
Right.
could look like a very nice property,
Mhm.
but is that a property you want to take back? Because if you do, then no property manager may want to go into that area and touch it, and next thing you know, it's basically the local neighbors are living in that property.
Mhm.
But yeah, it's very important for us, and that's why the loan to value is very, very important to make
Mhm.
sure that they have skin in the game.
Right.
Because you're right, we want to make sure they can afford the property, but if there's ever a default on
Mhm.
the paper, then our rights are the property itself. So we want to make sure there's plenty of upside or equity in that property to cover us if we have to go through the legal process.
Right. Okay. So the value of the property, the condition of the property, certain aspects about the borrower you're going to be evaluating and looking at the process where you did the seller financing. Did I check them out? Did I run their credit? Did I run them through a mortgage broker? Have I been using someone to service the note? How important is that? Maybe I created a note on a property 3 years ago. They've made payments on time. I've got proof of that, whether it's because I always made a copy of the check that they made their payment with, or I use not a servicer, but like we use Clear Now,
Yeah.
which is an ACH, process that takes the money out of their bank account. How important is using a servicer to you guys when you're rating a note?
It's well, we typically really want somebody who's a servicer, but
Uh-huh.
you just mentioned something that 99% of people don't do,
Mhm.
which is you take a copy of the checks. You know how to apply those payments and put them in. You know, if most people, if you said, okay, the payment's $500 a month and they only pay $400, how do you apply that 400?
Mhm.
And have you correctly put in the late fees? So if a borrower is delinquent, it's easy when they're paying, but if there's ever a blip on the map,
Uh-huh.
especially if it's owner occupied, there's a lot of steps and rules you have to follow.
Right.
And if you don't follow that, then that can impact really, it will impact recovering your money, not in the sense
Uh-huh.
of, oh, the loan's voided, but they can start disputing the fees and then it can delay things. And then technically they could get some CFPB violations, which, they're like $50 or $100 a whack.
Mhm.
But it's the fact that, time is money. And if they
Right.
get an attorney who starts looking into this and say, oh, this wasn't applied right, this isn't applied right, they'll just stand in front of the judge and say, we don't know how much we owe. They need to tell us because they've been doing it wrong all the time. And
Mhm.
then every judge is basically going to be like, okay, come back in 6 months.
Right.
So that's where we like to see a servicer being used.
Mhm.
And on a lot of these deals, I think one thing that a lot of investors don't realize is when you're generating these documents, you can put in there that the borrower cover the costs of the servicing. And I recommend if somebody does that, confirm with an attorney. That's allowed in your state. Most states it is. But also, put in there, I include the cost of the servicing. Don't put a dollar value, because over 30 years, do you think the cost of servicing today is going to be the same, as the cost of servicing 30 years? So.
Right. Right. I got you. Okay. And, I have, and I just being honest, I know you and I have talked about this before, and in years and years of doing this, anytime I've been asked this question, I have never, ever recommended a servicer to most investors. And that's because when I got started doing this, was over 20 years ago, there weren't many servicers, and they were expensive, and they didn't do the best job, to be honest with you. I mean, your borrower could not make a payment for a couple of months and you wouldn't know about it. I mean, I've heard a bunch of cases of that. But I will say, I know I've talked to you, and you are a partner in a servicing company now. And I had a long conversation with the young lady you have that runs it. And I mean, she seemed very knowledgeable, and it's also very affordable. You want to give us the name of that servicing company again?
Yeah, it's called BIFI, BIFI Loan Servicing, and initials are by investors for investors. And you hit the nail on the head. I got so pissed off with the servicers I was using that eventually I'm like, okay, this, I just need to kind of control this more. So I ended up, bringing on some business partners to go start a servicing company. I'm not active in the day-to-day, and that's not my expertise, but like you said, it's, standard servicing's like $20 a month. If there's escrow, it's an extra like $5. But they'll handle the taxes, the insurance, the 1098s and 1099s at the end of the year. Again, they'll collect all the payments, they'll apply them properly, put it in your account. They also can track, as part of that, they'll track to make sure there's insurance on the property. They track to make sure taxes are being paid. And if that stuff's not being done, then they can at least notify you, or they also have a portal you can go log into and see everything that's going on. They'll send a weekly report to you on the status of your loans as well, to see like, okay, what's the next due date on this, or if somebody hasn't paid, what their goal is for that week. Hey, I'm going to reach out to this borrower. So they'll handle a lot of that for you, which, on 1 or 2 loans, most people are like, hey, I can do that myself, not a big deal. But also when you get 20 or 30 loans and you're chasing money, it starts to take time away from your business. And, if you got 20 loans, and they're all somewhat paying, $400 a month, how much is that next deal costing you? And most people, I know I make more than $400 on a deal. So it's kind of, it's one of those things where what's the best use of your time and money? It's like anything. At a certain point in time, you try and do as much in-house, and then if you start to scale, you can do it outside of that. But one of the things that I know people ask about that is, especially on the subject to side, is, the servicers typically cannot pay that first mortgage in that other person's name. They can collect the payment for the one you originated, but on that first, I know it gets a little tricky with some of the laws and so forth. But I just find, again, it's so much easier to have somebody handle that. And if I'm, again, originating the paper, I'll put right there in the note basically that, hey, it's going to be serviced at this company for a time being, and they'll add the cost of the servicing to, so if it's $500 a month, basically, okay, they'll pay 520, and that covers that cost. So you're basically getting it for the service for free.
Right. I know, way back when, the servicers, and I don't know if there are laws that are different now, or rules, or things just evolve over time, but the big thing about a servicer was they would accept the check from your borrower, they would pay your underlying mortgage payment, and they would send you the rest. And that's just kind of the way it worked. I know when I spoke to your girl that you got running there, right? She said, yeah, we can't make that underlying mortgage payment, but it's just so easy now for you to set that up as an ACH, and you guys just pay that out of your account, and then we handle all the stuff on the other side. But for 20 or $25 a month, that's a big difference. I mean, I was quoted, $75 or more way back, and like I said, that was years ago when there weren't but a few. around that you could use, and they just the service was just horrible. But I've heard really good things about her, and
Yeah.
had a good conversation with her.
Well, it's also things like, if you're doing the contract for deeds,
Mhm.
that sometimes, people will do, the borrowers typically can't get insurance on that property
Right.
because they're not on title. So the
Mhm.
servicers, they can set that up for you, basically be like, hey, you tell me how much you want it insured for. We run it through our program. And again, it gets added to the borrower's cost every month. So you're not having to do the accounting. On that, or if you need to advance the taxes because the taxes got paid late and so forth,
Mhm.
they to me, somebody handling all that math and doing all that mental gymnastics,
Right.
again, what's your time worth? If you say you're worth $40 an hour, are you spending more than 30 minutes a month on that?
Mhm.
If it's a borrower who's you know some a good payer, even the good payers, you're probably still updating your books and stuff, still spending 30 minutes. So
Yeah, that's for sure. Okay, well, speaking of insurance, we're
mhm.
going to take a quick break here and let you guys hear from our sponsor today. Big Insurance, whether you're a rehabber or a buy and hold guy, landlord, you like to do seller finance, they can handle all of your insurance for you. And it's probably going to be less expensive than what you're paying now. And these guys know how to handle sub too, because guess who explained how that stuff works to them. So if you're doing Sub2Deals, they won't give you any trouble about that. So we're going to hear a quick message from them. We'll be right back. Birmingham Insurance Group is a full-service property and casualty insurance agency laser-focused on risk management solutions in the single-family residential space. Their master policy program is available in all 50 states and was designed by investors for investors. It provides tailored coverage and competitive premiums, specially for real estate investors, owners, and property managers. Give Jason or Corey a call today at 205-682-8856 or visit them at their website, bhaminsgroup.com. That's BHAMINSGROUP.com. So you guys give Jason or Corey a call. They've got an incredible setup there. They've got an insurance portal. You can go in, get a quote 24 hours a day. It's got some setup there where you start typing in the address and it actually pulls the property up. It knows square footage, bedroom. I mean, it knows everything and can give you an exact quote. And when you're ready to bind it, you just go in there, click a button, and pay, and bam, you've got insurance. No inspections required, no vacancy exclusions. If you got vacant rental property, it's pretty amazing, really. So you guys check them out. So Chris, let's. I know you've got a website and you also do a podcast.
Yes.
Tell us about that.
Yeah, so the podcast has been going 4 years now. And the reason I started the podcast was in real estate, you see a lot of people with a lot of very high, expensive training.
Mhm.
And a lot of people would, just ask the general questions. And, we wanted to provide an avenue for people to kind of just get some education or hear the case studies, because a lot of the education is, again, very high level. It doesn't really dive into case studies or the weeds. And it really started when with Gail Greenberg, who was my original co-host. I was driving home from work every day and we'd call each other and vent. And it was basically talking about some of the crazy stories that we had going on. And we basically said, we should market this. And, jokingly, like, how can we do that? And at the same time, somebody had mentioned me as like, yeah, you should just do a podcast. And podcast, too much time, effort. I don't want to do that. But as people can probably realize on this show, I like to talk. So we launched a podcast. It was called Good Deeds Note Investing Podcast, where we were just, talking about notes, case studies, lessons learned. And for investors who are trying to get in the space, before you go spend, $10,000 or $15,000 on some initial weekend warrior training, really make sure you understand the basics, because a lot of times people get so excited when they go into certain training courses, they don't know what they don't know.
Mhm.
So some of those courses might actually, could be worth the money, but
Right.
you need to have some level of experience. But if you don't know don't know anything, you're not going to know what information's more important than others to take away or walk away from. So that's kind of how the podcast started. And throughout the time, we've had several different guests, hosts on it. And actually, I'm bringing on a new host, and we're starting to actually rebrand our podcast. And we talked prior to the show, why would somebody rebrand the podcast? And, we're trying to diversify a little more. And we've talked previously about other different investment strategies in real estate. So we're changing it up a little bit. It's going to be called Creating Wealth Simplified. We're going to be talking more about some of the logistics of also investing, things like using a self-directed IRA, other creative financing strategies like subject-to deals, and bringing on people like yourself to talk about how they get started in building passive income like you do with some of these subject-to deals. We'll have people probably talking about some short-term rentals, just all different avenues of real estate and investing, because I think we can add more value to a greater audience versus just talking specifically about notes. Now, notes is still going to be our bread and butter, but we just want to kind of expand and build upon that.
Okay. And I know on your website, do you guys offer any training or coaching or anything there as well?
So we have a small membership group. I call it the Seveney Note Syndicate. That we meet monthly. We meet weekly with people in the group. I usually limit the group to 20 individuals. So right now we've got a few open spots. It's $100 a month, which when you look at what you get for it, for me personally, I think it's well worth it for investors. You get access to all my files regarding forms and my calculator and everything that we use. Plus, we have a weekly chat where I'll either do a presentation or an open forum discussion. That's usually an hour to an hour and a half. So, you're getting my time for 4+ hours a month, plus all access to our forums, and people can set up one-on-one calls with me as well. So when you look at, what other people might charge for mentoring, I would say I'm pretty cheap once it comes down to it. But that's why we also limit the number of people in the group. And I'll be honest, I enjoy it, but I don't make any money off of it. Most of it we reinvest. It's more to help other investors in the space to try and grow in their note investing career.
Yeah. A lot of people, I think, don't really fully appreciate those of us, pat ourselves on the back here, those of us who teach, that keep teaching affordable. There's a lot of opportunity cost there for us. I know we were talking about that before we came on the show today. You can hire somebody that's, $10,000, $50,000 to spend 6 months with them. And is that an incredible value? Well, if you use it, yeah, it sure is. But some people just can't afford that sort of thing. So people that try to keep it affordable at cost to us, we can't run our real business because we spend time helping others because we feel led to do that. So, appreciate us guys, man, that try to keep it affordable out here.
No, that's an interesting point, because I know you've got a large Facebook group and I've got, one as well, and you have people in there. And I think sometimes, very rarely, I think 99% of people greatly appreciate what we provide. But there's always that one person who asks a question or sends you an email and it's like, hey, I'll get back to you next day or so. And then I get an email back. It's like, oh, since you didn't get back to me, I went to somebody else. And I'm like, hey, look, I feel like a politician. I can't please everybody all the time. But I think most people do appreciate it for the most part. So that's something that I enjoy. It kind of it feeds off of.
Right. It's, it really makes your day when you get one of those messages or emails or something from somebody that says, you really changed my life. I was having to do this, do that. And I found you, whether it was on your YouTube channel, wherever it was, and just listened to what you said and went out and did something and made X, and it just really changed my family's life. So I think that's why the main reason that we do what we do. Yeah. I remember what it was like, man, to work 70 hours a week and and barely be able to pay the bills. It's tough out there.
No, I think and that's one of the stories I like to tell to investors as well is, hey, look, 10 years ago, I had nothing. I was basically, I was, well, 15 years ago now, I was just finishing up a divorce, starting completely over, didn't own any real estate,
Right.
basically, basically, credit card debt up the yin yang, and basically it's like, okay, what's my focus? How I'm going to do it. And, it shows that, everybody goes through struggles in life, and everyone can, work things out and go through things. But by telling that story and also coming from that place, you see where other people are, because a lot of times I see people basically like, oh, you just do this, this, and this. And it's like, well, yeah, that sounds real easy, but you're forgetting all, the little steps and the increments that it took you to get there.
Right. That's for sure. It's like in teaching, where you try to explain to somebody how to do something. Some of the tiny little details are just so ingrained in you after doing it for a long time, you forget.
Yep.
What is that example they give you? Like, the best way to learn to teach is explain something really simple, like how to make a peanut butter and jelly sandwich. But if you leave out, even the tiniest step, the whole thing doesn't come out like you're expecting. So, yeah, I know exactly what you're talking about. Okay, so the key takeaways here for today, Chris, on if I want to create a marketable note, first of all, I need to make sure that I'm qualifying my buyer. The buyer needs to have a significant down payment and this is just to get the max. I'm sure even if I missed all these steps, you'd still buy the note, but I wouldn't like the price.
Yeah.
Am I right?
Yeah, and again, in some instances, you may still like the price. If there's a property that, for example, like you mentioned, still had equity or was in an area that was, a really good area of appreciating assets, and the borrower didn't have as much as a down payment, you might view that as a little less risk. So it's kind of a sliding scale is the best way to explain it. And if you kind of want to maximize value, hey, here's everything you need, and the scale slowly slides kind of to the left when you're leaving certain pieces and parts out.
Okay. All right, guys. So y'all check out Chris at 7einvestments.com and also his podcast, currently Good Deeds Investing.
Good Deeds Note Investing.
Good Deeds Note Investing, soon to be
Creating Wealth Simplified. But if you look up Good Deeds, it's still going to be under the same URL and all that stuff. So it's all the same history is there. It's not like we're eliminating all of that, because that was the first question I asked. I said, hey, look, all that historical data, all those downloads, because we've got, we're actually close to, I think, like 1 million downloads now. I'm like, that's not going anywhere. They're like, no, it's just, it's the same URL, same everything. So it's, just be a little different naming convention.
All right. Awesome. Okay. Well, thanks, Chris, so much for being here today. We really appreciate it. There's a lot to learn about notes. So we'll probably be having you back to talk more about that later.
Yeah. Well, thank you for having me, and enjoy the rest of your day.
All right. You too. Thanks so much. Okay, guys, that is it for this episode of the Sub2Deals Show. We'd like to thank our sponsor for today, which is Big Insurance. Make sure you guys give Jason and Corey a call. Whether you're a rehabber, landlord, doesn't make any difference. They can insure your investment property probably at a lower cost than you're paying right now. So you guys give those guys a call. And if you're looking for the most affordable creative finance coaching on the planet, check us out, $7coaching.com. If you enjoyed our podcast, we would love it if you would give us a 5-star review at Apple Podcast. It only takes a second, and it helps other investors find our show. So until next time, keep talking to some sellers, and you will buy some houses.